This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, back in our previous lecture, we saw what were the tax implications of membership of a gains group. We firstly, of course, had to analyse that group to determine who was in the same gains group. But when companies are bound within the same 75% gains group, it came with both responsibilities and opportunities. The responsibility. We had no choice in the matter. If one gains group member transferred an asset to another gains group member, then for taxation purposes it was transferred on a no gain, no loss basis. So neither a gain nor a loss would arise for the transferor company. So what value did that represent? I hope you're now remembering that that value was equal to the transferor's allowable cost or costs plus any available indexation allowance. Remembering again that indexation allowance got stopped, it was frozen at December 2017. So no gain, no loss transfer equals the transferor's cost plus available indexation allowance. That means that neither a gain nor a loss would arise. There'll be no gain to feature within the corporate tax computation of the company, the transferor company there for that period. And the transferee company is deemed to have acquired at that self-same no gain, no loss transfer value. What does that mean? It means that that base cost is no longer the price they actually paid for the asset. Again, usually 99 times out of 100 that will be a property. But it's no longer, the base cost is no longer the price they actually paid, but the value of the no gain, no loss transfer, i.e. the transferor's cost plus indexation allowance. Now there was no choice. That's how you handled any such no gain, no loss transfer between gains group members. But then, and now to be looked at in more detail, we've got two claims to elections that are available. Now, of course, remember, we've said it all the way through and we'll continue to do that through to the end of these notes, that wherever elections claims are available to taxpayers, we're only going to make them if they are beneficial to the taxpayer. Whether it's an individual in personal tax, whether it's a company now in corporate tax. What we've got to be aware of is what elections are available, recognising the scenario, if it is a written question, in which any relief is available, and then understanding how that relief works, and then determining, well, do I want that? Is that a claim that is now worthwhile? Okay. The two claims that were available to us. The most basic of these was the group rollover relief. Group rollover relief, which, as you can see there, and as we stated previously, simply meant that now, instead of the same company both selling and buying qualifying business assets and being entitled, therefore, to claim rollover relief on some part or the entirety of the gain made on the disposal, by rolling it over, by deducting it from the base cost of the newly acquired qualifying business asset. All that happens now, exactly the same technique, but it's one gains group member that sells and it's a different gains group member that buys, taking the gain from the vendor and deducting it from the base cost of the company buying the qualifying business asset. What is of more interest to us, and potentially therefore rather more examinable, is this election that allows, as we have seen here, to elect that any part of either a gain or loss incurred by one gains group member, one company, one gains group member, may be treated as arising in any other gains group member. So what advantages, therefore, do we have of gains group membership? Now, in relation to that specific issue there about the ability to allow any gains group member within your group to crystallise by selling to a third party any chargeable asset, to crystallise any amount of capital loss, any amount of capital gain. Because after the end of the accounting period, we could look back on each of the companies within our group, and if we wished to move any part of a gain, any part of a loss from one gains group member to any other gains group member or members. Any part. We're not shifting all of the gain, all of the loss, though of course we can do that. The election is far more flexible. It allows any part of a gain or loss made by one gains group member to be deemed to have been made by any other. Well, that's fine, but so what? What does it do for us? Where are we going to apply? Why would it be worthwhile? And the first point we have here is that the group's capital losses can be better utilised. And if we move to our next note, 5.4 here, dealing with capital losses, it says, an asset does not have to be moved between group companies in order to match capital losses and capital gains. Now, you may recall that when we spoke about group relief of losses, we dealt with trading losses as being much the most likely, and also property business losses there. We said that we do not have group relief of capital losses. We have something else. This is that something else, and it's actually better than group relief in relation to capital losses. An asset does not have to be moved between group companies in order to match capital losses and gains. Companies in a gains group can make this election to deem, here we go again, any part of, note that, a current period gain or loss made by one group member, one gains group member, and deem any part of such gain or loss to have been made by any other gains group member or indeed members. And the beauty of this, it could be done retrospectively. The election has to be made within 2 years of the end of the accounting period in which the asset is disposed of outside the group. Now, the reality is that you're going to ensure that you make these claims by the time you submit your corporation tax return, and probably even before that, potentially, the time you have to pay your tax. You will have moved these before you submit your corporate tax returns and before you pay your tax. The advantages of the election. Got a 2-year time limit, so as we said, you don't therefore have to think at the time when a gains group member is selling an asset, is this the company that I really want this capital gain or this capital loss to be within? Because we can allow any of our gains group members to sell, crystallise any gains or losses, because up to 2 years after the end of that period, we can move those gains or losses around at will. So we don't actually have to move the ownership of the asset. We are simply able to move the gain or loss for tax purposes at that later date in relation to any given accounting period. So by not having to actually transfer assets within a group means a saving in legal and administrative costs there. Now, there's a tax called stamp duty land tax in relation to properties. It's not a part of your syllabus. You don't have to worry about it, but that normally attaches to the purchase of a property. That would be a cost if we were having to buy and sell these properties. But it's not an issue now in relation to this because we don't actually have to transfer assets from one company to another. We can deem gains or losses after the event to have been made by any gains group member. And the election, as we know, in respect of any part of either a gain or a loss. So let's just now have a little example and illustrate the way in which that might be of use to us. Okay. Oops, where are we? Okay. Let's imagine, therefore, that we've got holding company, we've got S1, we've got S2. We know that the minimum requirement for gains group member is 75% ownership. The reality is it's normally 100%. We can therefore recognise that all three of those companies are in a gains group. And what happens during an accounting period is that this company has made a gain of £100,000 and this company, S2, has a capital loss of £80,000. Now, as that stands, were it not for the election we are now discussing, think what would happen. S1 has got a capital gain of 100,000. That 100 would be included within its corporate tax computation as a part of its TTP, and S1 would pay corporation tax on that gain of £100,000. While, for the same accounting period, S2 experienced a capital loss of £80,000. What would happen to that capital loss of £80,000? It would be carried forward. So we, without this election, would be paying tax now on a gain made in S1 while being unable to immediately utilise the loss made in S2 and having to carry it forward to set off against future net gains of S2. But that won't happen now, because now we can make our election. Now, we are able to deem any part of a current period gain or loss made by one gains group member to have been made by any other. So what could we do here to minimise our tax cost? Well, the simple thing to do is we could deem that the capital loss made by S2 was instead made by S1. What would that mean? Now in S1's corporate tax computation, you'd have a £100,000 gain minus an £80,000 capital loss equals a net £20,000 gain. You'd have been able to reduce S1's TTP by some £80,000, saving tax thereon as a result. Now, if you wanted to, there wouldn't be any reason to do it this way, but if you wanted to, you could move £80,000 of the gain from S1 to S2, thus absorbing the otherwise unused capital loss within S2. If you wanted to, of course, it doesn't have to be just 80,000. You could move all of the 100,000 if you wished. What that would mean is instead of the net £20,000 gain arising within S1, now if you moved all 100,000 of the gain across to S2, that would more than cover the capital loss of 80,000, and it would leave a £20,000 gain there. So you have the ability, therefore, to yield that net gain somewhere within the group. You're going to have net gains of 100,000 less 80,000. It need not be in S1. It can be in S2, or indeed it need not be in S1 or S2, because you could transfer both the gain and the loss into H. So we've got this absolute flexibility. So the first point is we're not, therefore, having to pay tax on a gain while carrying forward the capital loss. We can net out gains and losses within the group by either taking the gain to the loss or the loss to the gain. Or if we wish, we could move each of those two figures, both the gain and the loss, into another gains group member. Well, here that would be company H. Just one thing. We said that the election is available in relation to any part of a current period gain or current period loss. So just one thing to bear in mind if we had this slightly revised situation, that now the capital loss of £80,000 in S2, I'll now tell you, is a brought forward capital loss. If it is a brought forward capital loss, it's not a current period loss. Therefore, you can no longer transfer the loss to the gain. That is no longer a possibility. But is it a problem? No, of course it isn't. What did we just say we could do? We could move any part of that gain across and deem it to have been made this period by S2. We would, of course, move at least £80,000 of our £100,000 gain from S1 and deem it to have been made by S2, and that would then absorb all of the brought forward capital loss within S2, and again, we'd end up with 20,000 net gains taxable this period rather than £100,000 of gains taxable. So there we go. We've seen there how we can use this. It's sometimes known indeed as a matching election, because we're able to match gains with losses within the group. But remember, we can only move any part of a current period gain or current period loss. But if, as we've seen here, we have a brought forward capital loss, it's still not a problem. We simply move the gain or any part of it into the company with the brought forward capital loss, so we achieve our matching of gain and loss that way. Okay, back to our notes now. Now then, in relation to these capital losses, the issues that we've come up with so far are to be able to net off gains against losses within the accounting period, so that we do not end up with the situation of paying tax on a gain in one gains group member while carrying forward a capital loss in another company. But there's another issue that we might here have to deal with. Another advantage of gains group membership. Gains may be moved to a company with insufficient profits to cover its qualifying charitable donations. We've seen when applying loss reliefs that loss reliefs where its current period or carry back claim within a company, the current period and carry back claims, the loss reliefs that are claimed are against total profits, and they can't be partial claims. So therefore, if we've got insufficient profit to absorb the loss, so there's more loss than there is profit, all of the profits disappear, and then there's nothing to deduct the qualifying charitable donation from, and it is therefore wasted. So what we would be able to do now is to move a gain into a company that otherwise had insufficient profits to cover its qualifying charitable donations, whether simply the donations were bigger than its profits, or, of course, if we were dealing with a situation where a loss relief was going to be applied in that company, and we'd end up wasting those donations. We don't now have to do that. We can boost those profits by bringing in a gain from another gains group member. Or, and what is an important issue in terms of group relief as well, we could move gains out of a company where its profit exceeds the profit limits for purposes of making quarterly instalment payments. We saw how with group relief we would move losses into a company whose profits were at the moment just above the profit limit, therefore potentially leaving it exposed under the quarterly instalment payment system, something we would not wish to happen. So what did we do? We brought losses in from a company and brought the profits of the company down below the profit limit to avoid any possibility of having to make quarterly instalment payments. What we're now saying is that rather than moving a loss into a company to reduce its profits below the profit limit, what we may have is we use this matching election to take gains out of a company where its profits would otherwise exceed the profit limit for purposes of making quarterly instalment payments. So we can take out a part of the profit, i.e. the capital gain, any part of that gain. We're shifting it to another company, but we're taking it out of the company where its profits at the moment are above the profit limit. We therefore, if we've got sufficient gain to be able to do this, can remove from those profits any part of that gain so as to bring down its profits to the profit limit, and therefore again avoid quarterly instalment payments. Interesting concept that, and difficult to take on board in your heads, no doubt, just in the form of words. So let's have a little example to illustrate this one, if we may. Right, back here somewhere, there we go. Now here we have, again, a very simple structure. We've got our 75%, it happens here to be 100% group, do make a note again of these examples so you've got them stored within your notes there. And we have the holding company that has, for the current period, a taxable total profit of £450,000. S1, its wholly owned subsidiary S1, has a TTP of £560,000. S2 has a TTP of £600,000. The additional information you are given is that within the £560,000 of gain, there are gains of £80,000. Chargeable gains of £80,000 are included within the TTP of 560. And though S2 had a TTP of 600,000, that left an unused net capital loss in S2 of £20,000. What are we therefore able to do? Well, your first thoughts, I would hope, given what we've just been talking about, is that if we've got a capital loss here of £20,000 that at the moment is unused within S2, and we have chargeable gains of 80,000 included within the TTP of 560, if that is a current period loss, then we could move that loss across and reduce those gains from 80 by 20 down to 60,000, and that therefore would reduce that TTP by 20,000 down to £540,000. If, of course, this capital loss was a brought forward capital loss, then we take 20,000 of those gains across and absorb then the brought forward capital loss. Now that's as good as it gets. It means that is £20,000 of gain that won't now be taxable at all in any of our group companies. But let's assume that we've done that to absorb that loss. What that therefore meant at that point was that the TTP here within S1 had been reduced to 540,000. Now look again at those profit figures and think about the significance of quarterly instalment payments. I have a TTP of 540 that now includes a net gain of, well, no longer 80,000 because we've reduced it by the 20,000, it includes a net gain of £60,000. We have in H a TTP of 450 and in S2 a TTP of 600,000. Quarterly instalment payments. Now, as that stands, are there any companies in the H group who are going to be classified as large given their level of profits and therefore may have to make quarterly instalment payments? Now, you've got to think carefully about this. Think about what we know about groups, what we first got introduced to in chapter 16 and have mentioned again within this chapter. There we have H and 2 wholly owned subsidiaries. That means that there are 3 related 51% group companies. 3 related 51% group companies. So that means that what would have been a 1.5 million profit limit is now divided by 3. So that now it's 0.5 million as the profit limit for each of these companies. So H has a TTP of £450,000. It is not large. S2 has a TTP of £600,000. It is large. S1 has a TTP of 540,000. It too is large. So at the moment, both S2 and S1 are large companies, and therefore we may have to make quarterly instalment payments, not only this period, but potentially next accounting period as well. Again, depending on, as you'll see in chapter 23, the next chapter, whether we were large in the previous accounting period, whether we'll estimate ourselves to be large in the next period. But you can clearly see there that we have a profit limit of £500,000 and S2 has a profit of 600. it is a large company, and at the moment S1 has a profit of 540, and therefore it too is a large company. Now, if there were loss reliefs available within this group, we could of course firstly look at S1, and if there was £40,000 of loss that could be applied, apply it in S1 to bring the 540 down to 500, equal to the profit limit, therefore do not exceed that profit limit, therefore we are not large. But there are no losses. The only loss that existed was the capital loss, and we've already used that to bring down these gains of 80,000 to a net 60,000. But it still left us with 540,000 TTP. So, what do you think we would now do with our matching election? Remember, at this point, we have net gains of £60,000 within S1. The matching election is available. We want to reduce these profits by £40,000. 40 is less than the net gains that exist here of £60,000. The matching election would allow us to deem any part of those gains, here net gains of 60, they were originally gains of 80, but any parts of those gains to have been made by any other gains group member. So if we can shift £40,000 of these gains out of S1, that would bring the profit down from 540 to 500. We would not exceed the profit limit, and on that basis, therefore, we would avoid any possibility of having to make quarterly instalment payments, both for this period and indeed for next period within S1. Well, there's only two companies it could go to, either H or S2. Where do you think you're going to take it? Well, of course, you're going to take it to H. We're going to transfer here some £40,000 of those net gains into H. It's got 450, 450 plus 40 equals £490,000 of revised TTP. 490 does not exceed 500, and on that basis, it will not be large. It stays as a not large company. That means that rather than having two large companies within our group, we are now left with only one large company. Sadly, there was nothing else that we could do to bring the profit of 600,000 of S2 down to the 500,000 profit limit, but we've been able to remove S1 from being categorized as a large company. H is still not a large company, and we're left therefore with only S2 as a large company. Now that's a much more difficult exercise there than we are maybe used to dealing with. It's probably pushing the boundaries of what they may require at here the taxation level, maybe getting up to advanced tax level there. But it's the sort of thing they could still do, and hence therefore be aware. To be honest, I hope you find that the more challenging things are actually the more interesting things. Though again, interest is not an issue, I suppose, that you have to concern yourself with here. It's a mere matter of passing this subject that is your sole criteria. Okay, going back to our notes therefore, we've seen how we can use capital losses most efficiently within the group. We've seen how without losses, even gains may be moved around within the group, basically there to try to bring a company's profits down from above the profit limit to the profit limit to avoid the possibility of having to make quarterly instalment payments. The other point, as we know, is that rollover relief is now available on a group-wide basis. Here is all the detail that we've gone into in relation to those capital losses. And finally, for you to have a go at and then have a thorough review, please, through the answer, another little challenging issue for you to discuss the elections available to the group companies and how they may best be used in relation to this information here in example 5. So have a good think about that, see what the options are, How would you exercise any claims or elections? How would you achieve what you want to achieve? And then have a thorough read through. Then in relation to what we've been discussing in this chapter, quarterly instalment payments, the details of that you will then find in the next chapter, chapter 23, for you to review through.